right? So hello ladies and men. We are so glad to have you here tonight. We know it was a little bit of a last minute change last time, so thank you so much for your attendance and coming back. We really appreciate it. We put a lot of work into this event, and so we hope we make it worthwhile for you and that you come back from this event tonight inspired to lead your best financial lives. I'm Lauriane Maher. I am the host, the founder and creator of a podcast called Deep Pockets and Stilettos, and I'm going to be moderating the panel tonight. On my podcast, my goal is to help women feel more empowered in their financial lives. Basically, it's about managing the money that you have, earning more money, and feeling confident in that you're in charge while doing all of that. And I know I not only speak for myself when I say that as women, it's easy to oftentimes feel excluded from money conversations, from the financial conversations. We feel like we don't necessarily have a seat at the table. So actually, I kind of want to get started by asking the audience a few questions. So first question, who here considers themselves an investor? Raise your hands. Okay, that's actually pretty good. And so who here, second question, has a 401k at work with money in the market? Okay, so my point is, why were they way more hands raised on the second question versus the first one? They're exactly the same. It's because as women, we feel that an investor doesn't resemble us. We don't want to own the persona of the investor, but an investor does not have to be a man in a gray suit. It can resemble us. We can put lipstick on the word investor. And that's kind of what we're here to do tonight. So we're going to debunk some myths around investing, and we hope you leave here with concrete steps to grow in your financial journey and to manage your money better. No matter where you are, if you're starting from scratch, if you moved to New York yesterday, or if you've been there your whole life. And to do that tonight, I have a wonderful panel of speakers. So on my left, we have Cameron Rogers. Cameron has been working in the wealth management and financial industry for over 15 years, including more than a decade at JP Morgan as a private wealth advisor. And today, she's working at Elevest as a private wealth advisor as well. If you don't already know, Elevest is an investment company built by women for women, meaning that it includes facts that are oftentimes excluded from traditional investments, such as, for example, the fact that women outlive men, and so that they need more money in retirement because they're going to live longer. And so that move is actually in perfect alignment because Cameron has a passion for financial literacy and helping women gain agency over their finances. Then we have Katrin Koroff, who started her career at the very young age of 14 as an international model, and earning money at such a young age and prompted Katrin to become financially responsible very early on in life and to have to manage her money. And it also sparked the entrepreneurship, her entrepreneurship spirit, and she started a company called Model Club that was a savings app for models. And then it prompted her to participate in the launch of several fintech startups, and her career as an entrepreneur was launched. And today, she's joining us and she's doing it again as the CEO of Frisch, a social savings app that allows you to compare your expenses, how much you spend on groceries, how much you spend on dating, how much you spend on rent with your peers, and create social challenges in the app. And then we have Wendy Wexel, who is the CEO and founder of the executive coaching firm Wexel Partners and the creator of the very important, very often forgotten EQ of wealth. Through her work, Wendy helps next gen, people who have inherited money and need it to be managed, and ultra high net worth individuals manage all the side of wealth that is left out by the traditional investment industry, the emotional sides, the stressors that comes with in families that inherit money, the relationship aspect of managing and growing your money. It's really financial expertise that goes beyond investment literacy. So ladies, thank you so much for being here tonight for the panel, and please give a big round of applause for our speakers.
I like to think about, our personal interconnectedness to money as number one, and the reflection around that, and we'll have our own reflections, and then really like where we are. I know that sounds very simple, so we'll talk about a couple of steps. The interconnectedness of money and how you understand money really plays into how you grew up, how your family talked about money, how your family did not talk about money, how you interact with partners around money. I personally felt privileged to be in a family that talked about money early on. My mom took me to open up my first bank account. I think I was like 8, imagine me now, but like, a little nugget with like a bob at a bank, signing papers and, depositing my lemonade sale proceeds and my money from grandparents. And the interesting thing about that time is the economic environment was actually not dissimilar from today. The Fed funds rate, which is the market interest rate in the US, was around 5%. So for a little kid with a savings account, you had a decent interest rate. I remember seeing that money grow while I was not doing so much, and that was astounding. And then when the savings rate decreased, I was like, why aren't you giving me so much money? Like, this is bullshit. So that was kind of like the kind of early understanding of the interconnectedness of money and things. And look, it's not always a linear upward trajectory. I had same realizations around money when, my family split, and a lot of that kind of back and forth related to money, and partners were disadvantaged around money. So we all have to think about how we've learned the interconnectedness of money, and I would say that's kind of the far more personal. And then I would think about where you are, because if you don't know where you are, you don't know where you're going to go. Show of hands, and I want this group to be honest. This is not shaming, but how many people really looked at last year's tax return that they filed? Oh, this is pretty good. Okay, I'm very impressed. And how many people feel like they have a good sense of where they're spending, where their money's going, kind of who the company that they're spending the most with? Okay. So these are actually, like, before we even talk about investing, these are the two things I would focus on. Tax return, what your income is. Is it from employment? Do you have a side hustle? Do you have income from elsewhere? Do you have income from investments? Are you taking tax deductions? Are you appropriately and efficiently contributing to various retirement schemes? So that would very much be step one. It sounds boring, but 100%. And then step two is really that spending piece. And I want to caveat one thing for a moment, because so much of the literature out there and marketing out there around women and money is that women's power as it relates to money is thrift. Not the case. So debunk that. Like we need to get beyond thrift, and I know I'm talking about spending, but it is deeply important to know where you are spending, because kind of anything you're spending money on, you're effectively borrowing from something else in your life, including long-term investing, either your taxable portfolio or your retirement portfolio. So it's really good to have something to help you. You can talk far more about this. I also use an app called Rocket Money. I'll actually give one final anecdote before I turn it over. But as a New Yorker, I am so proud. I walk everywhere. I take the subway. I really try and be great about everything. I finally signed up for Rocket Money, which categorizes all of your expenses, where you're spending money, and the company that you're spending the most money with every month. Guess who I spent the most money with consistently every month for the last 3 years? Uber. So you need those kind of accountability apps, platforms, things like that. We all need it, even the financial professionals in the group, because with that you can then say, okay, Cam, cut out some Ubers, you're not sort of living as you say you are, and maybe redirect some of that money. So those would be sort of the the two things, again, thinking about your story and the interconnectedness around money, and then where you are, because if you don't know where you are and what you're doing, it's hard to say, like, this is how much I'm able to commit on the investment front and how I'm going to invest. So I would anchor around those two things.
Do you want to build on that, Catherine or Wendy? Or
Yeah, I mean, there was a lot of great insight here. I would like to take just a little bit of a different approach in thinking, like, what's even our relationship with money, which is where I feel like it often gets really messed up. So I feel like we often focus so hard on working, making money, getting a promotion, getting a side hustle to make more money, but then when it comes actually to the part what we're doing with money, that's almost like shameful, right? Like, you can't speak to your friends about it. It's almost like weird to sit down and think what are your financial goals, whereas it's so normal to spend like hours looking at like your fitness goals or your career goals, like obsessing over your relationships. So one of the most practical tips that I started a while ago was just spending every week like 30 minutes thinking about my money. Like, what are my long-term goals? Like, doing the really scary thing after a weekend every Monday, looking like what did I spend my money on, which is traumatizing every single time. And just taking that time kind of as a self-care, half an hour, and getting over that fear of money and getting over like not knowing what's going on. And I think like if you spend like 40 hours a week working to earn money, you can take that 30 minutes to think, what are you doing with that, right? Like, what's the end goal here? Like, do you want to retire early? Do you want to afford a different lifestyle? Like, I don't know, maybe you want to live abroad. And I feel like getting that 30 minutes, literally like scheduling it in your calendar, like if you schedule like a meeting every Monday or whatever day you feel best, I think makes such a huge difference. And I think like that kind of accountability, maybe you want to add a friend to the mix and like every Monday you check in if you guys are doing this. Like, we're so normalized doing this for fitness goals. Like, it's so normal to have like a running buddy or like a gym buddy. But like, it's so weird to never do that for money when that's, you know, one of the things we spend most of our days working for, right? So I think my main point would be to schedule it in and like consider it like a weekly meeting or like weekly date with yourself where you feel empowered about that topic.
Thanks, Katrine. So, who will have a hard time scheduling that 30 minutes? Yeah, so that's my work. So the thing is that these are emotional. This is an emotional experience that you're having. It's not logical. And so, Lillian was so kind to talk to about like, you know, the work that I do, and I work with very wealthy families. I also work with founders to move money. And so my story is that I got a trust fund through my grandfather and talked to that. I spent all my money, and I've done that 3 times. But I'll tell you, the first time was I had a trust fund, I didn't know what was in it, and money through my grandfather was very positive. He was self-made, and he lived very humbly. He was my hero. My regret is that when he was alive, I didn't sit down and talk to him about finance, because that's what he wanted. He wanted me to be empowered. And so if you see my necklace, this is my grandmother's. I was his wife, and she got her college degree at 82. And so I just want you to know that I just want you to think about for a moment that you could be most likely your grandmother's wildest dream come true. Just the fact that you're here. And so I had a very positive experience with money through my grandfather, a very negative experience in my immediate family. It was something that was always contentious. And so I avoided it, and I spent it to feel good and rebel. And I put myself in a really tough situation. The first time was the trust fund, the second time as an entrepreneur. So it's actually really interesting. You talked about having a 401k. I'm like, I can't wait to have a 401k. As building a business, you have a Roth IRAs are also quite good. Actually, we can't give financial advice, but Cameron can. And so the second time was actually investing to invest in grow somebody else's business. And the third time was my own. And the best money I ever spent was investing in me. And our emotional relationship to money. So the thing you have to realize, if you're avoiding it, avoidance is a sign of stress response. And so, what is stress response? Stress response is a physiological reaction that you experience under threat. And so, oxygen is rushing to your heart and to your paths, but where isn't it going? Your brain. because we are ancient beings in a modern world. And so that threat that you are experiencing is very real. And so that's actually, the avoidance is an experience of flight. And so I just want you to also know that it's okay. And some of this is just physiological and it's completely learned. And I will say, the emotional stuff, when you really get to it and get to the root of it, and this is why I work on it, not only because personal experience, but also professionally, I love money. I love raising money, and I love putting money towards things that are really meaningful. And raised through this work over $110 million to abortion rights, mental health, and climate change. So fuck yeah, money. Once you get to because when the emotional kicks in, and it's also a physiological experience, you take action. And so it's okay that it's emotional. That's actually a great thing. And the thing that I actually really want everyone to do here is talk about it. Because the other thing about money is that, raise your hand if you want to be deeply loved. I hope everyone is raising their hand. Otherwise, you're going to find a therapist. You're like, people. So, who wants to be deeply loved? Yes, I love it. So, and this is actually Staff and Elder, so I should say Cam is a dear friend, and I actually go to Cam, and we should have people we go to for advice. One of the top predictors of divorce is early arguments about money. And so the thing is that because money is not talked about, it's taboo, and what isn't talked about becomes shameful. That is, shame exists in silence. And so what happens when you're not talking about money in a relationship, whether that's within your family, within your friends, within your colleagues? You're also not talking about if you're struggling with addiction, if you're having a rough day, or what your fucking dreams are, and what your hopes are. And so money is actually an amazing conduit of connection. Because if you can talk about this really huge thing that's important to your life in a really compassionate way with someone, you're able to be deeply loved. Because it's such a big part of relationships and usually such a big block of connection. And so, talk about money. Literally right before I saw my friend Rachel, I was like, let's talk about money. Let's go. And so, talk about it because yes, it's also, when it's stigmatized, it becomes shameful, and if you want to be loved, know it's going to be an issue, and so if you're able to talk about it, you are opening up the vessel of connection and love. And then the other thing is, it's okay if it's hard. Because it's not that you're not doing anything wrong, it's that you might actually be going through a physiological experience, which is stress response. And so all this can be fixed, and not fixed, you don't need to be fixed. You're perfect. It's just all shiftable. And so I fucking love money, and I would also say you love money. Because if you love money, you're gonna want more of it, and you want more in your life. So talk about it, say you love it, and be kind to yourself if you're having a tough time. Because it's actually, you're just going through a fear response. And you're gonna be okay. Thank you.
Thank you, everyone. So what I'm getting from your answers is that exactly money is not really on, or our financial goals are not really on the same footing as our fitness, our dating goals, and it's wrong, and it should be, because we use money in, our daily life. But for some reason, we experience the psychological resistance to taking action and managing our money, and sitting down at the table with a pen and paper and writing down what our budget is, or what our expenses are, and what are our dreams. And that's actually okay. And it's not gonna feel, we're never gonna be enthusiastic to do this. I mean, maybe down the line, I know I am, but I'm a weirdo, so maybe that's not. So yeah, I think it's great that you said that, and the fact that it's not gonna feel like a picnic in the park at first, and that you need to overcome that resistance to get to the other side. And so going to continue with that, so that's the first step, checking in with yourself on a weekly basis. Take some time in order to think about how you spend your money. How did you spend your money this week? Does it feel in alignment with who you are and what your dreams or what your goals are? What could you have done better? And so now I kind of want to talk about broader notions of investments and investing, because I would like the audience to leave with a investing 101, Not that everyone's going to become Warren Buffett after this evening, but I think it would be great to get into a little bit of typical notions such as index funds, ETFs. What the heck is that acronym? What accounts should you use? How you can optimize your account? How much you contribute to 401k? All of these good practices that I think would be interesting for day-to-day management of their money when they have this weekly check-in.
First and foremost, I love that your weekly check-in is Monday mornings, because mine is like wine chocolate time, so it's very different. Look, there are steps. I think there are steps to know that you have the capacity to invest. First and foremost, I would think about, again, going to this idea of what does your tax return look like? What does your spending look like? A tax return is not a balance sheet. And if you think about a balance sheet, it's your assets, what you have, and your liabilities, what you owe. And I would add in a protection piece. So I think before the long-term investing conversation, it's really sort of a diagnostic of, okay, what do I have? What do I owe? What is higher priority? And so I would say first and foremost, think, high interest debt. Debt is so binary, and I feel like it's even more binary for women. I know, by the way, women pay higher interest rates on their debt, so what's going on there. You're either in debt or out of debt. We all know that, debt can be good, and debt can be capacity building and create further wealth, but it's really thinking about what's what I think, student loan debt, good debt, mortgage debt, potentially good debt. Credit card debt, it's hard to justify, in most cases, the capacity building of whatever you're purchasing versus, the cost of the borrowed funds that you're using to purchase that thing. So I would think about the debt equation, and if this group has specific questions, we can talk about it because it's very nuanced. And then effectively, an emergency fund. An emergency fund is, what it's described. It's a pool of money. I like to think, to the extent that we can do it, 6 to 12 months of spending that's set aside for effectively an emergency. Fix the roof, help a loved one, help a relative, kept in cash, not invested. But pre the investment conversation, it should really be those two things. And then when we think about investing, what you're investing in should really match the goal of what you're solving for. So if the goal is shorter term in nature, if it's coming up, that money should not be in the stock market, right? The stock market is long term. When you're investing in the stock market, you're investing in a collection of companies, and what you're, effectively thinking about and hoping for is that they grow their earnings. Tend to think that markets are efficient and are going to get more efficient, right? The advent of AI, increased use of AI, we're going to have more and more access to information. So any sort of information advantage is hard to get. So use of low-cost ETFs, kind of as a tool, but then being really thoughtful about what you're putting where. I always get questions like, what about that next thing, that alternatives investment, that angel investment, that investment property? And what I'll say is you really have to set up the boring base. Crypto is part of that same group. You really have to set up the boring base and get that going for you before you think about the other piece. And then what's so important with the other piece is sizing and risk and timeline. You know, a lot of those private investments are longer term in nature. And so I'll pause there. I can obviously go on forever, but those are my initial thoughts.
Yeah, thank you so much for all the awesome insights. Well, first I wanted to share a data point that I recently saw. And very recently, when I was like panicking and Googling some data points on my way here. Women, 20% of women feel confident about investing, which means there are 80% of us who feel insecure. But then when you actually look at the data, women's investments way outperform men's investments because we're way more analytical, we're a little more careful, we're a little more thoughtful. So I think again, there's so much that comes through our mindset here that's holding us back. And from my own personal story, I feel since I first thought I want to start investing until I actually started investing, it took me maybe like 5 years because I made this whole thing such a big thing in my head. I was like, you know, one day I'm gonna be the investor girl and like boss bitch and all this is gonna happen. But I'm like, today I'm not ready for it. So I spent years thinking about it. I researched a bunch. I felt like I need to know so much. And then when I finally downloaded an investing app and just literally put like tab to invest like, I don't know, 50 or $100 every week, I was like, oh, that was it. Like the thing that I prepared myself for 5 years took me 5 minutes. So I would say if there's someone who's not investing that much yet, like don't make things too complicated for yourself. Like what was just told, like first you want to have your emergency fund, right? Like you want to make sure if you lose your job today, you're set for the next 6 to 12 months. But after that, if you don't feel you're a guru investor and you don't want to be that yet, like again, it's not investment advice. You can put your money in like S&P 500, just let it sit there, and you're probably going to do pretty okay. And I think for those who are afraid to get started, this is such a great first step. And what I also recommend, because I'm kind of lazy and I like to make things simple for myself, you can just go to the app, make sure it's reoccurring, so once it's done, you don't have to be anxious about it anymore. It just goes off your account every week or every month, whatever you set up. And I think it sounds so simple, but yet so many of us don't do that. Like it just sounds even too obvious and silly to say it, but yet there's so many of us who don't invest, who are afraid to get started. So super simple advice. I would just make sure that whatever you're comfortable with investing, whatever money you're not afraid to lose, and if you want to play it safe, just go for the S&P 500. Make sure you schedule it in so you don't have to think about it.
What they say. I'm the emotional stuff. I cannot give financial advice.
Thank you, ladies. Yeah, that was a pretty good wrap up on the debt and also making it simple because I think sometimes, like Catherine, to your point, like we make a big thing of something that is as easy as ordering an Uber, right? So it's really, really simple. You can do everything from your phone, and the first time you're going to do it, you're going to feel more resistance than the second time and the third time. And many of you already have 401k, so you're already doing it. You're just not owning it and not raising your hands when I ask who's an investor here. And I also think that the question that I get a lot is regarding the emergency fund, because it's no surprise that we live in a high cost of living area. So 6 to 12 months of expenses is a lot of money. So how do you prioritize? Do you say, okay, I'm gonna first get my emergency fund set up and then in the end I'll start investing? But my rebuttal to that is, well, you kind of want the compound interest to kick in as early on because of the time value of money. So how do you navigate what is a good balance between those two competing goals since we live in a very expensive area?
That's a great question. I think you can think about sort of if the worst did happen, could that number be lower? Could it be 3 to 6 months? I say 6 to 12 months because it's just been a crazy 4 years that none of us could have foreseen. What I will say is the flip side is if you do invest that money and you have a year like we had last year where you invested kind of, the principal and then you had stock markets down 20 to 30%, if you need to draw on that money, then you're drawing at a 20 to 30% discount. So it is very nuanced.
Basically, fill it out, kind of contribute to the best of your ability, so it's not, so sad to only put money in a savings account, and you can still invest a little bit in something that's increasing over time with compound interest.
I'll say one more, sorry. I'll do one more thing. Between March of 2022 and today, the Fed funds rate, which think of it as like the base interest rate of the economy, which a lot of other things are kind of priced off of or based off of, has gone from 0 to over 5%. Savings accounts and other savings-like instruments are based off of that. I feel like cash, it's very easy to say like it's over here, not gonna look at it, whatnot, but it is important to kind of go into that savings account and really see what you're earning, because there are opportunities to earn a little bit more on what I would call cash-like instruments, whether it's a money market fund or short-term treasury bills. So that would be like sort of the one thing that I would go in and look at, because we've kind of gone from 0 to 100 in that respect, and you can now earn 5-ish% on that money. That's during a time when we've seen inflation be incredibly high, so things are more expensive, but it's something to look into.
Yeah, so right now I guess is prime time to build those fat emergency funds because the rates are quite high.
I would also say that if anyone wants to start a business, 12 months. 12 months. The expectation is you won't be making money for a bit. And so that might seem unreasonable, but it's actually what will give you the I can only speak from my own experience. It will give you the safety to be creative and to really grow your business. Because being creative and growing something is very challenging. I'll just speak for myself, it's very hard to think about growth when I've been so focused on just trying to make certain things work. So if you're really thinking about going out there, and that is a major wealth creator, owning your fucking business, that's how to own stuff. I say I wouldn't give financial advice, and here we are. But yeah, ownership. Ownership is how we make equity and money. So if you want to go out, if you can get that emergency fund to a year, from my own personal experience, I would recommend that.
Just whatever she said about this. Trust her, please.
So I think 2 takeaways that I took from the last 2 questions is that compound interest working positively for you is amazing. We want that, so put it in the market. Compound interest working against you, aka credit card debt, is not a friend. So tackle that first, so you're not making the credit card company richer. And then something else that I think is important is, and that I take away, is that basically you need to set up your financial life so that money is no longer a stressor. So the emergency fund, so you don't have to, for instance, stay in an unhealthy workplace with a terrible boss. You can just say, F you boss, I will leave because I have an emergency fund and I can find a new job that will value me better. So it will provide the relief that you don't need to stay in a very shitty situation, and also not making big things out of little things and kind of like removing the whole investment conversation from its imaginary pedestal. And so that leads me to my next point, which is more about the psychology. Why do we put money in investing on a pedestal and we think we're not up to it? Why is that? What are the invisible scripts that we have absorbed about money?
I guess I'll take this one. Invisible script. Where should we begin, ladies? I just want to come back to our grandmothers for a moment. If you were looking after your grandmother, this world was not built for us. It was built for very few white men of wealth. That's who the system was built for. our grandmothers couldn't have a credit card since the 70s. Is that it? 70s, couldn't open a bank account without husband's permission since the 70s. It's 53 years, so it's been a while, but we are all in a room talking about money, and so things change. And I will say that one of my lived experiences was the only time I met with my family's wealth advisor. I remember seeing the women at this private wealth firm, and where were they? They were all the secretaries. And so our relationship and our psychology of money is basically formed through our experiences, what has happened to us. It's generational, what our family's relationship was, and societal. What do you see? And so that's how it comes. At the same time, that can all change. And so that's not for me. Oh, that's too much. If I have wealth, then I'll lose my friends. It makes me evil. Like whatever it is. Like I will say, I know I've been very fortunate to know people that want to create change, and there are wealthy people who are very kind. So you can have wealth and have love, and have health, and actually health and wealth and relationships all compound. So it's not just money that compounds. So if we experience social isolation or loneliness, we are up to a 60% chance of having a premature death. And so if we want to be around to see that money compound, have great people in your life and take care of yourself. And so I just want you to know that no one is absent from those generational, experiential, and societal conditioning. With that said, once you know about it, it's totally changeable. And compounding is the small moments when no one's looking. So when is a small moment where you're just choosing to sit at the table? You showing up here tonight is you choosing to be wealthy. Just showing up. So I would just say, all of those things, yes, those are scripts that I know I had to unpack for myself. And they're also made up, because that's the thing about money, it's also made up. Because we used to trade salt, the currency of money has all changed. And so I would just say, know that that script could be there and everyone has one. And in the small moments when no one's looking, you can make a small change, and that will compound over time, just like your money. So all that to say is these are all formed from these different ways from our families, what we've been through, and also what we've seen here. With that said, it's all changeable. And it's changeable when you choose to make a very small decision. So those automated polls to invest, those are brilliant. That's changing your life. And so I just want you to know it's actually not the big things, it's the small things that really count. And that's also true for how relationships and happiness are formed, according to the research. So it is the small stuff. Really sweat the small stuff. That's all I got. Thank you.
But you want to build on that?
I'm just happy to share my experience as a female entrepreneur and how when I first started my business, because I know a lot of you here are thinking to start your own businesses, how that kind of felt like. In the beginning, when I started going to investors and raising money, or even thinking about business plans, there was still that voice in my head that felt like this is a very masculine thing, and I almost felt silly going out there to raise money, because first I come from super traditional family, or now you would say probably backwards. In my family, my mom was a stay-at-home mom, so already building a company myself felt kind of crazy. But then going out there to those huge funds and raise millions from them, it felt literally. I felt first massive imposter syndrome, and then I just felt like I don't belong there. And my first response was to be super masculine. So when I first started raising money, when I went on those investor conversations, when I started building my team, I almost felt like anything that's feminine feels wrong. And almost felt like I have to wear those big bro pants and act all tough and stuff. And then after a while I realized that no, hell no, it's my own company. I can build the culture that I want. I can tap into the things that makes you unique as a woman, which is being way more empathetic, understanding people better, being way more analytical. Like there are all these differences that we have to manage, which I feel we often underplay, and we don't realize that those are what make us really, really unique. And over time, I realized that I can build a culture that's based on like empathy. Like we can say, I love you at work, right? Like I just built a company where I always wanted to work in at myself. And for me, I just realized that you can kind of let go of the scripts that you have. You kind of have this, like our duty, like if we want to change things, like you have to build something that's different. Like you gotta be the person who builds your company, who changes the culture, who kind of breaks the pattern. Like you can get female investors, male investors stuff. Like you can get like most of our people who work at Fridge are female. Like we build their totally different culture, like one that I've personally never seen before. So I just kind of want to leave everyone with that thought. If you're thinking of starting something, like any script that you have in your head, like you can throw it away, just kind of start from scratch and just build something totally different, even if you've never worked at that kind of a workplace before.
Yeah. What these two amazing individuals said. I don't know if the scripts are that invisible. They feel very blatant, right? Like, imagine a founder, imagine someone providing for their family, imagine a big consumer, imagine someone gifting a lot of money away. Like, who do you imagine? Like, probably a white man. Not that there's anything wrong with them, but probably imagine them.
Yes, I don't mean to interrupt, but ask a white dude what he earns. When you're thinking about salary, ask men for what they make. Because that data is real if you want to make more money.
What I find, the script that I find more frustrating is empower women, because women have power. In the US, through employment alone, we earn about $4 trillion. I'll task anyone to figure out that number for unpaid care work, going up or going down. We know it's a lot. When we earn a salary, we reinvest about 90% of that back into our families and communities. We control 80% of consumption. Consumption is 70% of the US economy, 70. And when we have money, we give it away at a higher percentage rate. So this idea of empower women really doesn't work because we have power. The thought process is we really need to harness that power and pair it with money. And I think that's the last piece, but I think that's the really out there scripts that I have the toughest time with.
Thank you, ladies. Yeah, and communicate about it because we seldom see those statistics. So thank you so much for your inputs. We're going to move on to the Q&A session for the audience to ask your burning questions. But before that, I just quickly want to recap what we said. So, number one, make time for yourself to check in and think about your money, think about your goals. Second, look at things that cost you a lot of money, and that is debt, mostly credit card debt. Then think about building an emergency fund because you want to have freedom, and that can give you the freedom to make choices in your life. And then make sure you're fully aware of what you're making, how much you're spending, who are you spending the most with, and that you have money to invest to grow your wealth over time. And for that, you can choose a very simple index funds, the S&P 500. This is not personalized financial advice. So we can move on to the Q&A. So I don't know if anyone has a specific question.
Hello. Thank you all so much. That was really informative. I have a question. So I know Cameron from golf, but I also am familiar with LVS a little bit. And so my question is for all of you in terms of these platforms like LVS that allow you to kind of take a less active role in terms of like managing your investments. It's kind of like set it and forget it type of thing. And I'm just curious like what y'all think in terms of like what is the right ramp up for someone who's like getting into that? Like how active should you be in terms of like checking in on those types of things? Would you say like once a week, like you mentioned, or like, yeah, if you have any tips in terms of like how and when to like get into that? Just curious.
I'm happy to share maybe a little bit like controversial advice, but if you invest in something that's really safe, I often think that it's better if you almost forget about that app and don't check in, because what happens otherwise is at the end of the month, you go to that investment account and you take some money out and you, or if the money starts dropping down, like you start panicking, you overthink that, maybe you pull it out, but you know, if you look at like S&P 500 historically, every year it grows like by 7-8%, so you're probably gonna be pretty good. So I would say if you invest kind of in more like safe long-term strategy, I would just make sure you're automized and just kind of let it be, maybe check in once a month. But I think people often do the mistake that they invest their first like, I don't know, $25 and then they're obsessively checking it like every single day to see what's happening, but you're really there for the long term, right? Like you're there for the next 5 years, 10 years, like if something happens, if it fluctuates in a week, like it really doesn't matter. So I think that's kind of the other side of it. It's the one time that it's kind of good to be passive, in my opinion.
I think, Cam, the data aren't, when it comes to like money pickers versus robo accounts, don't the robo accounts win every time?
Yeah, they do. It's not like there's a difference between trading and investing for the long run. Like we're not having 3 screens in front of us with a Bloomberg monitor trying to maybe like place an option and like sell to make like $1 million in 30 seconds. Like that's not what we're doing. And it's very hard to actually do that successively if you look at the data. So, but I'm sure you have some interesting data points at Ellevest for that.
Also, 98% of the traders are men. Just saying.
That's why it is.
So I work with mostly women, having historically worked with mostly men. And the clients that I work with on the front end put me through the ringer. And we iterate and we think about what we're solving for and we fund, we invest in different things based on what we're solving for. And then they're like, I'm good. And that's not to say they're passive, that's not to say they're ostrich head in the sand, but they've really thought about the intention and purpose around what they're doing. And if you can do that, and if you can invest in the right things for what you're solving for, then the market environments like we've experienced, the last 18 months, they're not trading around that, they're sticking with that, and so they're not trading around future gains. So we do find women tend to be more measured in the downside, where men try to kind of like get out at the low and whatnot, and a lot of that feeds into the data as to why women are better investors. From a DIY perspective versus outsource perspective, I get the question a lot. Which I'll say one more thing around passive. For this group, a lot of you all may have single concentrated stock, and that's where I would be a little bit more aware, especially if you're working for a technology company, because that may move up, that may move down, and if you're completely checked out, that may become a big concentrated position that was not originally intended. So that's a little bit of a caveat, and I'll leave it there. And then I lost my train of thought.
Yeah, and what's a concentrated stock?
A concentrated stock would be, I would qualify it as, if you have liquid investments between your 401k and IRAs and taxable investment portfolio and cash, it's anything that really makes up more than 10% of that value. And history shows over time, it kind of makes sense to pare that back. This is not a recommendation to sell your Google stock, I cannot say that, but to just keep it Google, but to keep it in check.
And balance it out with other types of investment to avoid having dominance in a position. Some investors have succeeded, I have to say, but this is their profession, but never mind. Anyone has another question?
Thank you guys so much for differing opinions and perspectives. It's been really weird hearing my voice on it. Your differing perspectives has been really helpful, and I like that you all have such different backgrounds. I'm curious around how, and I personally struggle, and I know others have, how to find someone that you trust and how how to talk to someone about your individual situation. Maybe you have family money or you have tech stock or whatever, you have debt, you want to buy a house, whatever it is. And I know there's traps, like I've gotten in one where whole term life insurance was the thing that was pushed on me and I lost money on that, and realizing just so many different opinions and not knowing who to listen to and trust. And the curiosity around like working with someone who takes a percentage of your total net worth, or they pay them a project fee, and just what is it like a realistic amount to spend on investment advice, and just all these curiosities around like who to turn to.
Do you mind if I start this one? So Cam's my person, full disclosure, and I actually called her a month ago having to liquidate. I had to, things that were in my retirement, I had to release in order to pay for stuff, which is the way of entrepreneurship when you're building. And so I would say, in the same way that money in conflict is the top predictor of divorce, these are intimate conversations. And so instead of how you pick a person, it's who are you comfortable talking to? Because you're also sharing your dreams with this person, and you also need to share what you're afraid of. And so it's who are you willing to be fully vulnerable with? Because one of the things that also happens, and this is, and Ken can really speak to this, but people change wealth advisors all the time. When they get divorced, they're like, I didn't choose this person. And so who you choose is a big decision. And so it's also potentially a person, if you decide to have a family, who do you want on your team? Because it's a team. You're with this person for life, hopefully. And so I would actually answer it a different way. It's like, who are you comfortable calling and being like, I'm actually really scared to admit this? Or, yes, I just had a major windfall, getting $10 million, and then they're like, hey, Tiger, don't, it's like, who do you trust? So it's not who knows you, I should say, not who you think knows everything, it's who knows you. Who do you want? Who do you want to really know you? And then also I would make sure that what I've done working with various private wealth advisors is I talk to the people that work with them and be like, what's your experience? Tell me what it's like. Because they're probably going to want to, once you come on board, they're incentivized by what you bring in. And so, due diligence, or the process of really investigating someone, check the reviews, which is talk to the people they work with. I found that to be really, really helpful. And also, who do they specialize in? Whether that's multifamilies or entrepreneurs that are coming into money, or I have a lot of stock in Google. There are people that specialize in certain things.
Just one thing to add here, first, agree with everything you said. I think it's probably one of the most intimate relationships you can have, and one of the scariest ones. I think from a very pragmatical perspective, usually those people either take a percentage or they put you on a retainer. I think a good way to think about it is that it can save you maybe up to 20-30% on taxes if you're very clever there. So I think it's worth investing in, and that's all I'm going to say. I don't want to put any specific numbers because it really depends on the person. And then again, really, really highlighting, you want to find someone who deals with clients who are similar to you.
I do actually have a list of questions for anyone interviewing financial advisors that we can probably circulate afterwards. I'll try to kind of give a high level, but always ask about the fee model. So is it a flat fee? Is it based on the asset that's one's managing? Typically, that's not the only fee, because what you're investing in, whether it's ETFs or mutual funds or even private investments, have a separate expense ratio, so you need to ask about that. Most financial advisors won't disclose that. We always disclose that. Ask about what additional services are included. Do they tax loss harvest? That saved our clients hundreds of thousands of dollars in future taxes last year, given the tough market environment. Is financial planning included? Is there a community around the organization? how often will you meet with me? Is it monthly? Is it quarterly? And effectively, what is the service model and who is supporting me? So I'll get that document so it can go out broadly. But for clients interviewing me, where I know they're interviewing other advisors, I give them that document and I answer every one of those questions, and you should not feel bashful at all to go for it. Oh, also ask them how they're compensated. Truly, ask them how they make money, and if they balk or kind of don't explain, I would be a little bit wary of that.
So in terms of personal investing outside of a 401k, what tools or apps would you recommend?
I love to suggest one of my friends at Alinea here. It's also a female co-founder. And one of their Alinea, Alinea, it's female co-founded by two super awesome founders. But more importantly, what I really love about their product is they have created different playlists. So you can see what's the return on each playlist, which is like a bundle of stocks. And what I really like about it is that you can invest in the causes that you care about. So, whether you want to invest in environment or whether you want to invest in LGBT rights, anything that you care about, you can invest in that. And for me, that is made super easy. They also have AI tools, and I do with them the same thing that I explained before. I've automated everything, so I don't have to check it all the time, although I do. But you can then just automate and theoretically forget about it. So this has been my best experience so far.
All best.
I have my money now to change my
Sorry.
life.
If I were to name some others, I would say Betterment, Personal Capital, Charles Schwab's Intelligent Portfolios, Fidelity or Vanguard, but obviously LMS.
And also to manage, I love QuickBooks. It's really nerdy, but I actually check my accounts every day, and that's for the reason of when I have wealth and when you have wealth, a lot of wealth, it's gonna get really complicated, and it's gonna be really important to be comfortable in being exposed to money. And so whenever I look at my assets every day, I'm like, thank you. I'm grateful for you. And so I also find that 100% there's the robo investing and everything Katrina said is true, but from an emotional side, especially if you're avoidant, which was my tactic, I check it every day and say thank you, because once there's, once you have an enormous amount of wealth, there's just going to be a lot to check in with, and so having that practice of exposure, and I actually call that, and there are multiple, I rebrand things in order to make them super fun. But part of that's called wealthy time. It's about building the tactics of wealth and building a mindset of wealth. So I would say LMS, but also if you want to get organized, QuickBooks to manage it.
Okay, we'll take two last questions. We kind of need to wrap up, sorry. Thank you all, by the way. So yeah, I'm just really curious if you feel that you have an almost enormous amount in your 401k or your Roth, but you're not happy with your emergency fund. I think you mentioned having had to pull from your emergency fund at one point to start your business. How would you recommend approaching that process? I mean, so happy to have all that money for the future, but what if you can't? You feel like you're not as happy with how you're able to support yourself right now.
So this is, I'm not actually, maybe you can check me here, but the Roth IRA actually has a limit of what you can contribute, right?
Yes, there are some ways around that are legal.
Legally
Or it's a great question, because it's a question of, are you prioritizing you and needs now versus future you? And it's very much a balance. We tend to, you've probably heard this kind of rule of thumb called the 50-30-20 rule of how to effectively allocate one's savings. So to kind of explain to the group quickly, sort of 50% of earnings should go to things you really need to fund. So minimum debt payments, your rent, transportation, groceries, that sort of stuff. 30% should go to the fun stuff. That bucket is a little bit more fungible in the good and bad times, but you obviously need to, or you want to, account for the fun and the wants. And then the 20% is really that kind of future you piece. So there may be a time when that 20%, is split between emergency fund and funding 401k and or IRA, and that's okay, right? It's not a hard and fast rule that retirement needs to come first, but if we deprioritize it, then we're missing on that long-term compounding over time that really builds the kind of retirement buffer and retirement wealth. But I think that last bucket can go a number of ways, and then in many ways, that kind of first piece might be building up that emergency fund.
I want you to be mine.